This week, we saw cuts from the Bank of Canada, the U.S. Federal Reserve. We also saw the GDP shrink month to month. Let's get more on this from Gavin Graham. Thank you very much for joining us.
Not a problem, Roger.
We saw the cuts, Bank of Canada and south of the border, not surprising. We knew they were coming pretty much. The GDP was a little bit of a surprise. Where do those numbers leave us right now?
Well, I think it's one certainty is we're going to see more cuts. Although Mr. Powell for the Federal Reserve surprised the markets a bit by saying maybe there might not be another cut before the end of the year in the US, quite frankly, you'd have to think that they want to err on the side of helping support the domestic economy, which is feeling some pain, partially because of the tariffs. And certainly in Canada, it's very obvious that the GDP number, for example, being a negative number in August, I believe, and you're seeing economically sensitive stocks like CN Rail this morning, CP Kansas City yesterday, saying that they're seeing some issues with those sectors most affected by tariffs like lumber, steel, aluminum, autos, that the one thing the central banks can do is actually cut rates further. And Tiff Macklem at the Bank of Canada has said central banks can't do anything about tariffs, but the thing they can do something about is easing monetary conditions and reducing interest rates. So I think the quarter point cut this week is worth something like $15 for every $100,000 worth of mortgage that you have each month. So there's another $150 to $200 available for people to spend at a time when things are really tight. So there's going to be more cuts, I think, is the takeaway from what's happened this week.
And you think we'll see one before the end of the year, going into next year? Can they continue on that path, or is it going to be the point where we just have to start taking some pain with it?
Well, again, we're still ahead of the inflation numbers that the central banks have said they want to focus on, which is sort of effectively 2%. But realistically, if you are going to see these negative effects, which they've been talking about for a while, having interest rates below inflation for a while is not going to be too serious. It's not going to lead to a sudden spurt in inflationary pressures. Although, as you've noticed, there's been a fair amount of labour unrest, whether it's Canada Post or the BC Government Workers Union or the teachers in Alberta, because people are feeling the squeeze. Whatever the Bank of Canada might want to say officially, and obviously they don't want to tip their hand, you can expect further interest rate cuts. After all, we're down by more than half from where we were 18 months ago. It was 5% in Canada, and now it's 2.25%. And in the States, we're down from 5.5% before. You're going to see more cuts, at least in Canada. If Mr. Powell wants to actually keep the markets on hold for a little while, then fair enough, the US is somewhat stronger.
And now you mentioned, we all know tariffs are having an impact here, or we're feeling tariffs here, but you mentioned tariffs are having an impact in the States. What sectors are being hit the most by it, and what should investors be keeping an eye on?
Well, as we were touching on just a moment ago, obviously it's the ones like steel, aluminum, autos, lumber, where they're not necessarily covered by the USMCA, which, by the way, expires June next year. So obviously there's going to be a fair amount of discussion about how that might be reworked. And those are the ones where the companies are reporting numbers that are pretty weaker. The ones that are much more domestically oriented and also interest rate sensitive, so sectors like utilities, telecoms, financials, pipelines, are the ones where you might see some strength. And in fact, they've been doing pretty well so far this year. And the other thing is, and your previous guest was talking about the sort of bottlenecks that you're seeing perhaps in creating the capacity for the AI revolution. So as with the gold rush, you didn't actually buy people who were looking for gold, you bought the people who sold them picks and shovels. So the utilities which supply the power, the capital equipment companies that supply the hardware, the people who supply the cables for the grids, all of those look to be areas which should do pretty well. And by the way, that's an area which Canada has a fair exposure to, and you're even getting dividend yields that are quite attractive. Despite that, they've actually been doing quite well. Canada's been outperforming the S&P this year, a little bit behind the NASDAQ, and you might want to actually think perhaps about taking some profits on those major US technology companies. You saw one or two of the results this week. They're saying they're having issues with getting a return on the investment in AI, even though you saw strong numbers from people like Amazon, less so from people like Meta. So perhaps doing a little bit of rebalancing. After all, you probably have a much bigger exposure to technology than you did at the start of this year because it's done so well. Maybe take some of that off and put it back into those sectors which are not quite as strong. And maybe also you're now getting, again, over 3% in a 10-year Government of Canada bond, 4% in a US Treasury. Those are not unattractive returns at a period of great uncertainty.
And yeah, you still feel it is a lot of uncertainty happening right now.
I mean, again, we are in one of the most uncertain periods I can recall in my 40 years in the market. Uncertainty makes people nervous, understandably, and it's also very difficult to actually know what the numbers are going to look like because things change so rapidly due to the changes in policy. What you can say is if you're actually getting some of your return in the form of cash, that those are sectors which are somewhat defensive, then it's likely that you'll do okay. And also it'll be a lot less volatile than the major indices themselves.